Welcome back to another episode from TIC Talks at TIC Markets, where me and the leading expert Tim Finch talk to you about everything related to the financial market. Please, if you've been watching us for the last 4 weeks, make sure you do me a favor and give us a follow, subscribe to the channel. It will help us more than you think. So last week was a massive week. I think today we're gonna have to talk a little bit more about what happened last week. It was the big interest rate decision week last week.
Yeah, so we had 3 decisions that came out last week. It's rare that you get all 3 in the same week, but we had it last week. So the first one was on Wednesday, the 1st of February, the Fed meeting where they raised interest rates by 0.25%. The Chair Powell in the news conference afterwards, he seemed very relaxed. I think he believes that what they've done is kind of starting to show some signs of deflationary pressure. He still gave out the phrase that rates will stay higher for longer, but the FOMO group read his other statements as a bit dovish. So the market seems to want to believe or hope that interest rates have only one more 25 basis point hike at the most, and then they would actually need to fall at the year end. So equities immediately jumped higher after the press conference, and dollar was under pressure. But the market did wait to see what he said in the press conference before it took off. So that was the first one.
Do you think he was actually relaxed, or because he's been doing it for so long now, he's got used to it? Because I was watching the press conference, the Q&As afterwards, and some of the questions there, he looks like he's had enough, right? He looks like enough is enough. We can't deal with it anymore. We can't protect the economy. The Congress has to deal with it.
Yeah, when he's talking about the deficit ceiling, he makes it clear that's not my job. You know, that's down to Congress. We're the Fed. We're looking after inflation. That's our role. He makes it very clear, but it's boring for him because every time the news guys, they try to catch him out, right? They try to get a soundbite out of him or something different, you know, or they ask the same question again and again. I mean, if I was him, I'd be saying, look, I already answered that one. Next, you know. But he was relaxed, you know, he kind of like, he took it easy. So, yeah, good performance there.
You've sort of predicted it about Euro USD, and you told us if they raised interest rate by 25, then Euro USD will, will go on that streak of going long.
Yeah, so we've had the Bank of England did another raise of 50 basis points, and that was kind of widely priced in. That takes the base rates up to 4% in this country. But after that, sterling US fell after the news, and then on Thursday, the same day, the ECB raised rates by 50 basis points. Now, that only takes their rates up to 2.5%, and euro-dollar fell after the news. So it's only really the increase in US rates that's had a positive effect on the currency. The rest, it's pushed the currency against the dollar lower. But we did finally get that move we predicted in euro-sterling. So it went up from 88.65, where it was on Wednesday, to 89.80 by Friday. So keep watching this euro-sterling story. If you remember, the story is that there'll be a lesser recession, a shallower recession in Europe than in the UK.
Right. Meanwhile, the European Central Bank raised rates by 50, taking rates up to 2.5%.
Yeah, rates are still less in Europe than they are in the UK. We've got more inflation than they have. They think there'll be a shallower recession there, but I think they've got another 50 basis points to come, maybe in March. So, that's still an ongoing story, really. There'll be another rate rise in Europe.
Right. Meanwhile, in the battle of the TV pundits on equity, what happened last week? Tell us, please.
Well, if you've been following this story, we've got the 2 groups, right? We've got Don't Fight the Fed, which we're calling DFTF. This is where Chairman Powell keeps saying interest rates are going to be higher for longer. That should put pressure on equity rate markets, and we haven't seen the bottom yet in the equity markets, and that the dollar should be stronger. So that group has been out of fashion for the last 4 or 5 weeks. The other group we're calling Fear of Missing Out, FOMO, right? This is the group that says interest rates have peaked, inflation's coming down, the central banks might actually need to cut rates by the end of the year. So it's time to buy equities again. There's a fear of missing out. They want to buy equities. And so they almost use any excuse to buy equities. So they didn't need much of an excuse this week, right? We had strong rallies in tech stocks like Meta, that owns Facebook, Alphabet, Tesla, and Apple. All these stocks are up. You know, these companies have been cutting costs. They've got better than expected earnings. Their multiples have improved. So buyers are willing to come in at lower levels if they think the recession will not be too deep. But the TV guys are already saying, do we trust this rally in equities? Some think there's a kind of disconnect between the markets and what the Fed's saying. You know, FOMO Group thinks that US dollar interest rates will get cut in mid-2023. But what happens if the Fed actually does keep rates higher for longer? Equity markets could top out if the rates are held longer. So this week, week 5, the winner is FOMO after the interest rate rises. But they did have a bit of a wobble after the unemployment numbers. But for now, the equity rally continues. I'm a little bit suspicious about it, but let's see. But FOMO is the 5-time winner again this week.
Brilliant. And Friday, it was the US employment number, which someone wrote in the live chat as well.
Yeah, so this was a really unexpected number. When the number came out as a whopping 517,000 against the expectation of just 189,000. I mean, not one person I saw had 500,000 in their expectation. Most of them were like around the 150, 170, 200 at the most. And the December figure was revised up to 260 from 233. So the Fed's really not going to like these kind of numbers, right? I mean, you know, what's going on in these employment numbers? The employment rate fell to 3.4% from 3.8%, which is the lowest rate for 53 years. So are people running out of the money that they got from the government during COVID and having to find jobs? I mean, January, it's kind of like, you know, it's a period where people say it's a new year, new me, new resolution. Shit, I have to go out and get a job, right? So that's maybe what people are doing. So even at these low levels of unemployment, the tightness in rates is not really contributing a rebound in wage inflation. So, you know, it's still moderate, but is the impact of these aggressive rate hikes that we've seen, the most aggressive since the 1990s, has it been felt in the labour market? Well, not really. I mean, it's critical now because the central banks are coming into the second phase of their inflation fighting campaign. And if they're leaving behind some of their rhetoric and speaking about fighting inflation, if there was a pause in rates, then the labour shortage should keep the wage growth and inflation persistent. But what it means is if its rates are going to stay higher for longer in this new regime, it's almost like we've heard everything from Chair Powell now. You know, he's told us everything he wants to say, and the market interpreted it a bit different on Friday. They were a bit less FOMO and a bit more don't fight the Fed on Friday afternoon after the numbers came out.
Right. And about gold, let's talk a little bit about gold.
Oh, gold's had a really good run. I mean, it was up to 1950 earlier in the week. After the rate rises and the employment numbers, it topped out. It's back down to 1863. So, you know, the market had started to price in these eventual Fed rate cuts, and gold was rallying on that. But now if rates are going to be higher for longer, then maybe some of these asset markets are going to top out, and gold would top out as well. So $100 fall back to 1863 from the highs of earlier in the week on gold.
Brilliant. And let's talk about what to watch for next week.
Well, we always like to talk a little bit about crypto. It was a strong week for crypto. The support is still in place with a few retracements. One commentator that I watch said that the next target for Bitcoin is 28,000. And another commentator said it's going to be 45,000 by Christmas 2023. So what's the rationale for that? Well, he has done the statistics, and he said in years where Bitcoin has gone up in January, on 6 occasions, the rallies continued for the rest of the year, February to December, for an average of 245%. So that's how he gets it up to 45,000. Now, only in 2014, when Bitcoin had first started to become popular, did this not occur. That year, it went down 76%. Now, an interesting fact that came out this week is that in Nigeria, Bitcoin is currently at a 60% premium over the market price. So in Nigeria, they're paying 47,000 for Bitcoin. And this is because the government has blocked the ability for citizens to take large amounts of cash out of their bank accounts through ATMs. So people are turning to Bitcoin, and there's actually a shortage of Bitcoin in Nigeria, where people are willing to pay 2 or 3 times the price in the market. So as usual, crypto market is interesting but volatile. But yeah, I mean, it's been following the asset markets. So it's gone up when the equity markets have gone up. We've had a strong run up. We found the support earlier where it didn't go down when it was 18,000. And a good run up to 28,000 would be maybe as much as we can do recently. 45,000, place your bets, really.
I mean, what you just said about Nigeria, and people can't take cash out, like they have to take a certain amount of cash out of the ATMs. Now, with all these things happening, like in Nigeria, we've seen other countries, do you think people are more keen to trust crypto than the actual real
I think in some
currencies, if you like?
countries, they don't have a choice. If you look at what they did in Venezuela, where they actively brought Bitcoin in because there was such a huge inflation rate in these countries that the currency of the country was being devalued constantly. And so people were having to turn to Bitcoin and alternatives. Same in Turkey. In Turkey, everyone's a foreign exchange trader, right? Because the lira fell dramatically in some years. And they've had to turn to other currencies just to keep the value of their money. So, yeah, I think this is helping the acceptance of crypto. In the more sort of regulated countries and where they've got a strong currency like the dollar, it's not such a factor. But if you were living in Turkey and you saw that your own money was being devalued 50% a year, what would you do? You'd turn to something else, right?
Right. And do you think the United States of America would allow crypto to threaten the dollar?
They won't let it threaten
If
the
it
dollar
could,
because
because
the dollar is always going to be, the biggest currency in the world. The regulation that they're going to bring in will try to control crypto a little bit over there. But you can see that there's institutional acceptance of crypto now. Last week, we talked about the pattern of when crypto's going up during US time, that's institutional buying. When it's going up in Asia time, that's retail buying. More retail interest is in China and in Asia. So, we're looking at it and thinking there's more acceptance of crypto. There's widespread acceptance of blockchain, which is the method of supporting crypto. But things like FTX didn't hurt it. Well, that seems like a long time ago in November, right? Things move fast in the crypto market and the mood changes quickly.
what happens if people slowly starting to use crypto more than the USD dollar, and institutional, firms or big companies start, trading in crypto rather than the USD dollar? That will certainly sort of affect the USD
one of
dollar.
the companies that we talked to is in Canada. They do about 60% of all the flow in crypto in Canada. And what they're seeing is that small businesses are starting to accept crypto now for payments. So if you're a travel company in Canada and people are willing to pay in crypto, they accept the crypto, but they swap it straight out into fiat currency, into Canadian dollars. So there's a lot of this conversion going on. But that's the start of crypto being accepted as a currency. You can go and spend it in places. You can go into a cafe in Dubai now, right, and pay with crypto. So, this kind of acceptance is growing, and that just helps to strengthen crypto as a currency. Can it replace the dollar tomorrow? No, the dollar's been around for a long time. It's still going to be the world's biggest reserve currency for quite a while.
Absolutely. Let's talk about sterling.
Yeah, it's interesting. I'm in the UK, so I'm watching it. There was bad news for Rishi last week. He had to fire his Conservative Party chairman over his tax affairs. Apparently, Liz Truss is trying to make a comeback and try to push her growth agenda type policies. We don't want to see that here. And Rishi's generally still under pressure on all these old ministers from the Boris era and their bad behaviour. The strikes are continuing. Can he get past that? So they're looking for good news, right? So one piece of good news was the UK has joined this CPTPP group. You remember the CPTPP group is the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. So it's a free trade agreement between Australia, Brunei, Canada, Chile, Japan, Malaysia, Mexico, Peru, New Zealand, Singapore, and Vietnam, which was signed in 2018. But this could be a good deal for UK farmers to sell goods to Southeast Asia. Southeast Asia is still booming. The UK needs this because now we Brexited from Europe, our biggest trade market. Where are we going to get our next trade deal? So you can see the government is looking on a global basis. So when this news came out, it was just a minor positive for sterling. It bounced up about 40, 50 points, and then it got sold off again after the rate increase. So as we've always said in the past, sterling likes to find a range. So we found the top of the range at 124, 127, that kind of area. Now we need to find the bottom of the band. So is it at 118 or 120 or lower? We don't know. At the moment, it's still quite negative about the UK economy and about the strikes that are happening. So maybe there's still some pressure to come on sterling until it finds that base. But generally, it likes to trade a range. So yeah, maybe we'll try down to 118, see if there's some support there like there was previously, and then it's got its range that it can play in.
Did Rishi pay his TikTok video fine yet? Let's talk about China for now.
So this week, quite a few bits of information about China. Some of the commentators are saying, okay, there's been a fantastic rally in Chinese equities. Companies like TikTok, Tencent, they've all had a good run up. Is that done now? It was a short-term rally that kind of took over in January. If China re-emerges, is this positive for the RMB, the renminbi? It shouldn't be inflationary, so they're not so worried about that. Now, we called the move in dollar CNH, which is the offshore RMB, down all the way from 721 to 670. So what's next? It bounced back to 680 on Friday, and there was a slight negative for China because the USA caught a surveillance balloon which was flying high over US soil and says it's spying. And the Chinese government said, calm down, it's a weather balloon. But the USA is pissed off. They cancelled these bilateral talks that were meant to happen this week, where they were going to discuss Taiwan and the semiconductors that we talked about before, China's support for Russia in the Ukraine war. So watch out for that this week to be a thing. Watch dollar CNH and maybe Aussie CNH cross this week. They could go a little bit higher as the CNH comes down.
Brilliant. And what about the bond market debate? The bond market is calling bluff on central banks.
Yeah, it's the same FOMO versus don't fight the Fed debate. So this week we had the Fed, the Bank of England, and the ECB all raising rates, and yet bond markets have rallied, so prices have gone down. The bond market is just refusing to believe this hawkish narrative that's put out by the central banks. It's kind of stubbornly pricing in these cuts in the second half of 2023. Now, they may think differently after the unemployment numbers, as we said earlier, but when the central banks say we'll be data dependent from now onwards, that kind of adds a degree of flexibility. And the bond markets, they're really convinced that inflation will slow down to 2.5% to 3%. And if the central banks don't play hardball with them and keep the policy very tight, while instead saying they'll be data dependent, then the markets are going to do what they do best, which is push the path of least resistance and challenge unconvincing policymakers. If you're a central bank governor, you've got to have a strong policy statement and stick to it. So every time there's a bit of wavering, of course, the bond markets are going to try and price that in. So we've seen a bit of that, but I don't know. With these unemployment numbers, the Fed's got to think again. And I believe that everything that Chair Powell wants to say, he put out in his statement. He wanted to say rates will stay higher for longer. And if there is more wage inflation, they'll have to stay higher for longer. So maybe we won't get these rate cuts that the bond market's pricing in. And the bond market will have to change its mind again.
Well, let's see what's going to happen next week. But thank you so much for all these lovely insights. So now it's question time. Every week we're going to answer questions you guys watching have sent in. So we've got a question from Abdurrahman. He says, what's the most important, mistakes to avoid in trading?
Well, I think if you want to be a trader, you have to have an interest in markets. So you need to know the background to the market on two different levels. The first level, we call it macro, the economics, what's happening in the country or the currency that you're looking at. To understand some of that, that's what we try to give you every week, to highlight stories, to give you the macro background, if you like. The second part is technical analysis, and I like to combine the two. So I've spent many years studying technical analysis. If you're a trader, you study it all your life. And sometimes it helps, sometimes it doesn't help. But if you need to have a really good handle on the markets, you need those two things. And once you've got that, always start at the highest level. So look at the daily charts first and see where the big picture is going. Then look down maybe at 4-hour charts, then 1-hour charts. So if you're an intraday trader, you should be looking at 5 or 15-minute charts, and the hourly charts are your long-term charts. If your trading horizon is 2 or 3 days, you look up to the daily chart or even the weekly chart, and then look down to the hourly charts to make your decision. So my advice is always look up a couple of time frames to give you the overall picture. I've seen many traders come in and they've watched the market go down for days and days and weeks and just sell at the bottom of the market, and afterwards they regret it because on the daily chart, that was the daily chart support. And they looked at a 15-minute chart, clang, hit the bottom, and lost money. And if they'd only looked up a couple of time horizons, they could have seen it.
That's true. That's true. I've been there many times.
Thank you so much.
I do it.
Thank you so much. No, brilliant. Guys, we came to the end of today's episode. And before, I just want to add something to what you've just said there. We've also got this educational school. So we teach you about everything related to the FX market from A to Z, what's Forex, and the way we've built this educational school and the content is very entertaining and it's very detailed manners, and it's so we've brought Cristiano Ronaldo in the picture. If you like Kim Kardashian's, it's there. So we've made it so entertaining that you can relate to it in a way, and it's so amazing. It's an offer now, it's on a discount. Make sure you get it. And if you haven't got the time to learn, or if you haven't got the experience to trade, you can sign up for our managed accounts and we can, look after you from A to Z. Anyways, we came to the end of this episode. Thank you so much, Tim. Guys, please make sure you subscribe, like this episode for more episodes to come. And appreciate you so much. Have a lovely day, Tim. Thank you so much.